Dixon Development began operations in December 2009. When lots for industrial development are sold, Dixon recognizes income for financial reporting purposes in the year of the sale. For some lots, Dixon recognizes income for tax purposes when collected. Income recognized for financial reporting purposes in 2009 for lots sold this way was $12 million, which will be collected over the next 3 years, and the scheduled collections for the years 2010 through 2012 are $4 million, $5 million, and $3 million respectively. And what we're asked to do is to, assuming that there are no differences between accounting income and taxable income other than those described above, we're to prepare the journal entry to record income taxes in 2009. Now, pre-tax accounting income tax was $16 million and the tax rate is 40%. Okay, so let me show you the calculation that we need to make to come up with what that journal entry would look like. And I'll put that right down here. Okay, and what you see is pre-tax income, which was given as $16 million for 2009. We jot that down, and then we calculate or write down what the temporary differences are. And we had lot sales of $12 million, of which the taxable income on the tax return gets reduced by $4 million. And the reason is, for taxable income, we're not showing that $12 million of revenue until it gets collected in the years 2010 through 12. So as a result, we've got a taxable income amount of $4 million times 40%, and that gives us a current tax amount of $1.6 million. So with that information, we can make the entry. And what I think I'll do is slide this up on the screen where we can still see the calculation. And then I'll slide this right here where then you can see where the numbers come from. Okay, so the entry we need to make is income tax expense of $6.4 million and deferred taxes of $4.8 million and the income tax payable of $1.6 million. Okay, now I've put a little calculation on the screen right here, and what I'm trying to point out there is that if you wanted to know where that 6.4 of income tax came from, we take the full $16 million of the pre-tax accounting income times the 40% to come up with what the total dollar amount of income tax expense will be. But we've got a temporary difference that will get recorded as a deferred tax liability, which is the difference from the amount we're going to pay in 2009 versus what we're going to pay in the future. So that's how we come up with the $6.4 million. The calculation above came up with the current tax payable, which is really the $4 million times 40%. Therefore, the difference represents the deferred tax liability. Next, let's take a look at the second requirement. Okay, now you see the second requirement on the screen, and it reads, suppose a new tax law revising the tax rate from 40% to 35% beginning in 2011 is enacted in 2010 when pre-tax accounting income was $15 million. Prepare the appropriate journal entry to record the income taxes in 2010. Okay, now I'm going to move this calculation from part 1 away, and I'm going to illustrate what we would have to do on part 2. And since we're running out of room, I'm going to put it again in the middle, and then we can talk about this. Okay, so in 2010, they tell us that pre-tax income was $15 million. The temporary difference is $4 million of sales. Pre-tax income was $15 million. We know that we had temporary difference of $4 million based on the collection from before. And taxable income then is $19 million. So 19 income from the tax return times 40% gives us our tax payable amount of $7.6 million. So the entry we'd have to make for part 2 then looks like this. We've got to record in 2010 income tax payable of $7.6 million. and the income tax expense is $5.6 million, with the deferred tax liability now going the other direction for $2 million. Okay, now I moved some things on the screen so that you could see how we come up with the calculation for that entry, because I don't think I explained that in a very clear fashion where those dollar amounts come from. Okay, so you see what I'm moving here is the full calculation of what you would make for that second entry. So let me sort of talk my way through that. We've got a $2 million change, and the change goes the opposite direction. That's the $2 million we get here. Now we already walked through the $7.6 million, right? 15 in pre-tax for 2010, subtract the temporary difference of 4 million, or excuse me, add to it, we get 19 million taxable income. 40% tax rate times the 19 gets us 7.6. So 7.6 would be the current taxes payable. That's where the credit comes through. But then we have to walk through this entire calculation to come up with the 2 million deferred tax liability that needs to be decreased from where it was. So how did we come up with that? We've got 8 million left of temporary difference times a new tax rate of 35%. It means we've got a deferred tax liability of 2.8. The ending balance should be 2.8. We already had 4.8 on the books, so we've got a swing of $2 million, and we need to decrease what that deferred tax liability would be. So hopefully that's a better explanation of entry 2. Okay, next we look at requirement 3, which you see right here on your screen. Okay, and I'll read that. It says, if the new tax rate had not been enacted, what would have been the appropriate balance in the deferred tax account at the end of 2010? And that answer would have been 3.2 million. Let me see if I can put that calculation on the screen. Let me slide this over. Now we're not going to fit it down there, so again I'll put it right on top here so we can see it. Okay, so now you see it on top here. The balance in the deferred tax liability account at the end of 2010 would have been 3.2 million if the new tax rate had not been enacted. So we had 8 million of future taxable amounts times 40%, and that's where we come up with the $3.2 million calculation. Okay, so the effect of the change is included in income tax expense because income tax expense is less than it would have been if the rate had not been changed. And that's this problem, everyone. Thank you.